Some of you have asked how I'd invest my own money. So if I had 10k to invest, where would I put it? So what I'm going to do is very quickly show you the outlines of how I'm going to invest my own ISA. And I'll actually do it in front of you. But I can only go into so much detail in the space of this video, which is around 10 to 15 minutes. If you want more detail, I'm going to produce a booklet so that you can go through the process in a bit more depth. But also, if you want even more depth, you can do my asset allocation course, which you can find on my website, PensionCraft.com. So here we go. Remember, this is not a recommendation. If you want advice tailored to your circumstances, seek independent financial advice. The way I start investing is always to think about risk. But in order to think about risk, I have to think about correlation. And that tells me the structure of the markets I'm looking at. Let's say you had to describe the cast of Scooby-Doo to someone who'd never seen it before. What would you say? Well, let's start with the cast. We've got Velma, Shaggy, Scooby-Doo, Fred and Daphne. But a list of names doesn't tell me how those characters interact with one another or their role in the cartoon. But when we start to think about structure, we group people together. So first of all, let's group together Shaggy and Scooby-Doo. Those two are the clowns. They're not very serious characters, but they're the drivers of almost all of the action in Scooby-Doo. Then we have the leaders, Fred and Daphne. They're kind of preppy, kind of stiff, but they're the leaders of the whole group. You'll also notice that when they split up to explore a mansion, the clowns and the leaders go off together. Now finally we've got Velma. She's the kind of nerdy, intelligent problem solver of the group. Whenever there's a brain teaser, she's usually the one that solves it. She's not exciting, but she's smart. And the whole group is part of Mystery Incorporated. Now I could do exactly the same thing with a list of funds offered by Vanguard. These are the 18 exchange-traded funds I'll look at, because these are the ones available to me in my Vanguard Direct account. Now notice each of them has a 4-letter code that starts with a V, which identifies that fund. If you look at the top one, VUTY, that's a US dollar treasury bond. But it's really hard to understand how each of these things interacts with one another, just as the list of names in Scooby-Doo told us very little about how the cast interacted with one another. So here's a correlation tree which tells me how these assets behave relative to one another. Now you may be thinking this looks nothing like a tree. Most trees look like this. They have their roots in the ground and they have their leaves in the air. And you're right, this is a weird tree which grows from the left to the right. So the roots are on the left, the leaves are on the right. If I want to separate this into 2 groups or 3 groups or 4 groups, I can just take a vertical slice through the tree. There we go. So I've sliced it into 1, 2, 3, 4, 5 branches. And what's really nice is that the correlation tree tells me about the different asset types. So my top branch is split into 2 little branches. The top one is dollar bonds, which are denominated in dollars, and then I have euro bonds beneath that. The next branch is shares outside the UK. What's interesting is that all of those shares are highly correlated. In other words, it's very hard to diversify your portfolio by buying funds within that branch. Then I have UK mid-cap shares. These aren't the really big shares which are in the FTSE 100 with a very large market cap. These are the next 250 shares which tend to be more domestically oriented. And then finally I've got UK government bonds, a very safe investment. Remember, the UK has never defaulted on its debt. So let's bring back some of the Scooby-Doo characters. And remember, this is just my take on markets. Don't take it too seriously. So the shares excluding the UK are the Scooby-Doo. These global shares produce all of the action and the drama and the volatility of your portfolio. But over the long term, they provide the upside. The UK mid-cap shares, like Shaggy, are the sidekick. And the Scooby group and the Shaggy group would go together because they're both share funds. Then we've got the slightly boring leaders at the top. Fred is the dollar bonds, Daphne's the euro bonds. And finally we've got the slightly boring but intelligent Vilma, and she's the UK government bonds. She's not very exciting, but she's extremely reliable. Now we can also think about the volatility. Now what I've shown here is 2 of the funds. The one in red is one of the Scooby funds. It's a share fund that buys emerging market stocks. You can see that it moves up a lot and down a lot. But if you're willing to ride out that volatility, over the long term it gives you a better return than the more boring VGov fund, which is the Vilma Government Bond Fund. Vilma's got a much lower volatility, and even though she crashes from time to time, the size of the crashes is smaller and they occur less frequently than they do for equity. If we rank all of the funds by volatility, that's the typical percentage price move every year, you can see that the VFEM fund is right at the top. The VGov fund, the UK Government Bond Fund, is right at the bottom. There's a twofold difference in the risk between those two funds. VFEM is about 13.2% volatility and VGov is only 6.4%. So if we think about the risk of the funds, you'll notice that the equity funds are at the top, they're the most risky ones, and the government bond funds are at the bottom. So if you want more risk in your portfolio, you buy more of the equity funds. If you want less risk, you buy more of the government bond funds. Now here's a quote from Warren Buffett, which I find particularly useful. He says that he attempts to be fearful when others are greedy, and to be greedy when others are fearful. Now we're at the very top of a very strong bull market. You could almost say that markets are in a state of euphoria. Prices have gone up beyond the earnings of the companies. That's pushed up the price to earnings ratio by which we measure the value of stocks. But as Warren Buffett says, stocks can't outperform businesses indefinitely. At some point, prices have to come back in line with earnings, and that means stock markets will fall. So at the moment, I want to be slightly cautious with my portfolio because I think stocks are overvalued. This website by Star Capital, which is a German website, lists valuations for stocks all over the world. You can look at various different measures, such as Shiller's CAPE ratio, or a normal price to earnings ratio, or a price to book ratio, or dividend yield. But what's very clear is that US valuations are very high at the moment. Europe is also highly valued, but there are other factors which I consider which make it more attractive than the US. But valuation is something you should always consider when you decide what to buy. Another thing I look at is the PMI Indices, or the Purchasing Manager Indices, for each region. Now what's really stood out recently is that the eurozone PMIs have been extremely strong, and that points to stronger growth and stronger corporate earnings in the future. And that makes me want to take more risk in the eurozone, and it makes European stocks more attractive. If I compare that with the US, PMIs have also been strong, but you could say that they're starting to tail off. And combined with the valuation information, that makes the US less attractive to me at the moment. So what I'm going to do is I'm going to choose funds from each of the different branches. And that's because I want to diversify my portfolio. If I put too much money into each of the branches, those funds will be highly correlated, and I'll just be doubling up my risk. If I split money between branches, that reduces the overall portfolio volatility and the risk I'm taking. So in the bond branch, I'm going to choose a high-income US dollar EM government bond fund. Now I'm buying the debt of emerging market countries, which is very risky. But in return for taking that credit risk, I'm going to get a larger return than I would if I bought US government bonds or European government bonds. I'm also going to buy some more European corporate bonds because I think European companies are very well placed to service their debt. For the same reason, I'm going to buy some FTSE Developed Europe, excluding the UK, in the VERX fund. Now I'm a UK investor, so I'm also going to buy some of the FTSE 250 via the VMID fund. And finally, I'm going to buy some UK government bonds. This will provide some safety and some diversification from the equity which I've bought in my portfolio. In a market sell-off, the VGov fund will sell off least, it may even rally, whereas all of the stocks in the portfolio will fall. So those are my 5 funds that I'm going to buy, but the question remains, how much of each one should I buy? There are various mathematical approaches to deciding how much to allocate to each of the different funds. I've shown 3 of them here. The way I'd characterize them is the minimum variance approach on the left is the most cautious. That's the combination that would give me the lowest risk by combining those 5 funds. Maximum Sharp considers the momentum, so it would look back over some period, find the funds which give you the best return, risk adjusted, and put most of its capital into those rallying funds. But it also considers diversification. And then finally, risk parity is an approach where it looks at how much risk contribution you have from each of the different assets. So the assets which have lowest volatility would get the greatest weight, so that their contribution to the total volatility of the portfolio is equal. If we construct portfolios based on those different weights and look backwards in time, you can see that the best performer would have been maximum Sharpe. The worst return would have been minimum variance because that's extremely cautious. But you can also see that the risk taken by maximum Sharpe is much higher, almost twice as much as minimum variance. Now what I'm going to go for is risk parity, or at least a set of weights which are very close to risk parity. The return isn't stellar, but remember, I want to be cautious at the moment and not take too much risk because I think that other people are greedy, so I want to be cautious. So here's my portfolio in my Vanguard ISA. You can see that I have 16,700 in cash, ready to invest. I've already bought my exposure to European corporate bonds through VECP. So now I'm going to buy VEMT, which is my emerging market bond fund. So I click on invest. I have two choices. I can trade at the next trading point, or I can trade using a live price. If I trade using the live price, it costs me more, so I'm going to go for the next trading point. So I choose a fixed income fund. I scroll down to VEMT. Here it is, Emerging Markets, US dollar Emerging Markets Government Bond, and I want £3,310. Then I click on Next. I choose my payment method, and I'm going to take it out of the cash which is already in my ISA. Use my available cash for the payment. So I'll check that and confirm. And I also confirm that I've read the key investor information documents for VEMT, and I submit. So now that transaction will be bundled with other transactions that Vanguard does, and they'll trade that at a very good price sometime today, and I can go back to my account overview. So what I'll do now is I'll put in the rest of those transactions. Okay, so that's all done. You can see that I have 4 pending buy orders at the bottom. If I want to look at those transactions, here they are. To accompany this video, I've created this booklet which lists all of the Vanguard ETF funds which I've been talking about, but also some of the ideas which I discussed during the video. So for example, what are funds, Scooby-Doo, and then what each of those different funds exposes you to. And you can find that resource on our PensionCraft website. But remember, all of these allocations are relevant to me. They've got nothing to do with you as an investor. Just use them as education, don't take them as investment advice. Your risk appetite and your circumstances will be completely different to mine. But hopefully this has been useful in showing you how I approach asset allocation. And if you have any questions at all, remember you can book a power hour with me on PensionCraft.com. And if you want to see more of these videos, subscribe to our YouTube channel.